Morning, everyone, and welcome to Knorr's Business Growth webinar series. Today, we're having Preparing for an Investment. This webinar has been put together to help you gain insights into the investment process, understand the various forms of investment, and learn how to navigate the key stages of securing funding. The session will empower you with the knowledge and tools to attract the right investors, negotiate favorable terms, and ensure your business is investment ready. Knorr is a firm of over 75 staff specializing in offering compliance and business support services, outsourced bookkeeping, payroll, and management accounts, as well as compliance. We're a multi-award winning online accountancy and company secretarial firm supporting SMEs across Ireland, Northern Ireland, and the UK. Your host today is Larissa Feeney, CEO of Knorr and Chartered Accountant. Larissa proudly dedicates her time to overseeing the growth of her digital-first company and giving back to local community by contributing to numerous entrepreneurial programs and boards to help to empower ambitious businesses. This morning's expert guest is Robert Dixon, partner at Mason Hayes Curran. We're very pleased to have you joining us this morning, Robert. Robert advises a broad range of Irish and international clients in many sectors. He advises on private mergers and acquisitions, corporate investments, private equity, joint ventures, and shareholder agreements, partnerships, and venture capital. It's important to note that this webinar is for general information purposes only. For specific advice, we always recommend reaching out to an expert directly, and we'll share Aaron Roberts' contact details at the end. That being said, Robert and Larissa are happy to take questions today and would like to see interaction from you throughout. So please use the chat or question and answer feature, and I'll pose your questions to them on your behalf. So I'll now hand over to Robert to begin. Thanks.
Thanks very much, Christina, and delighted to speak today to the guests and with Knorr. It's obviously we would work together with Knorr for a bunch of different clients and provide different services. We're a full service law firm, and I myself, as Christina has said, work a lot on kind of corporate transactions, including investments. So I suppose in terms of what would be useful to go through today is preparing for an investment and some of the different things to think about in advance of taking investment if you're looking at doing so. So we can move along, I suppose, first of all, to look at the first I suppose the first thing I wanted to mention, which is the different types of investment that can actually take place. So first of all, there's equity, so you can subscribe for shares, I suppose, as if there's going to be investments, and that means that the investor will have a percentage of the company after the investment, but there won't be a kind of obligation to pay them back, so to speak. There won't be a debt in place, and the commercial question then is what percentage will they acquire? And there can be different types of shares. There's ordinary shares and preference shares and different types like that. Ordinary shares are very plain vanilla, I suppose, and give a right to a shareholder to a kind of the appropriate percentage of voting rights, and to a kind of the percentage if there's ever an exit and that sort of thing. They get their amount of that. I suppose there can be hybrid types of instruments. You could talk about a preferred share there, for example, that's kind of almost debt-like, but that there's or a cumulative a cumulative dividend being owed on a particular share, which means that every year 8%, for example, has to be paid to the shareholder, or it accumulates over time. So that's a hybrid type of instrument. And then just to call out, everybody participating here today knows that debt is different, but it is kind of sometimes talked about as an investment. And certain types of investor will put, say, types of debt into a company, and that's obviously very different in character. It means that it has to be repaid at a point in time. There's also kind of sometimes with debt, there's an ability to convert that debt into shares or at a certain point in time, depending on milestones. So those are all things to be aware of. They do all exist. I suppose sometimes I know there's probably different participants that have varying ranges of experience in taking investments, but I suppose when you see a term sheet from an investor, you might think that it's all very normal and it's the way it always works. Actually, there's tons of different ways that this can work, and it's worth being aware of that. You don't necessarily have to give away a percentage of the company if that's really something you're very against it. But debt, I suppose, might create, for example, where you're not giving away a percentage of the company, that creates a kind of a repayment obligation potentially every quarter or every month, which might not be the right thing for your business at a given point in time. So that's in terms of forms of investment. That's all I wanted to talk about there. And then I suppose in terms of types of
Robert,
investment, yeah,
Robert, sorry, I'm just going to stop you there if you don't mind.
sure.
Something came up with a client recently, and I just wanted to ask you about it. So the question was about a growth share,
Yeah.
and how a growth share could help a business owner retain perhaps some of that they thought may help grow their business. Can you talk to us a little bit about what a growth share is?
Yeah, absolutely. So a growth share you won't have a growth share as the only share in your share capital. So you might have all ordinary shares, for example, as the only shares. You own a business, there's a company up the top of it, and there might be 1,000 ordinary shares. But what a growth share does is it incentivizes whoever holds the growth share. It might be an employee, or it might be an investor that's going to contribute, or, it essentially, the terms of the growth share, the better that the company does over time, the more that growth share will actually be worth and will yield for the particular person. So the terms of the growth share, obviously it's a well-worn path, but they're a little bit complicated when you see them first. But it's effectively, it might say something like, if there's a 50 million exit, all ordinary shareholders get pro rata, let's say I said there 1,000 ordinary shares, everyone gets their equal amount of that 50 million once all obligations of the company are paid back. You might then have the growth share on top of that, where forget about the 50 million. It might literally say in the terms, if whatever you achieve above the 50 million, your holder of the growth shares gets a higher proportion of that. So what that means is, if I hold the growth share, I'm incentivized to try and make the company do as well as possible. And if we do get above that 50 million mark, I don't just get my normal percentage, or it might be that the growth share doesn't give you anything at all unless you get above the 50 million. I then get a higher proportion of the sale proceeds. So that's why these things are meant to incentivize. And as a similar thing, I've kind of talked only at a high level about a few types of share there. There's employee share option schemes and things like that as well. And all of that is intended to incentivize, if you have 20 employees or 75 employees or whatever it might be, an employee share option scheme, it's all intended to say, listen, we're looking for extra effort here. We're looking for you to really want the business to succeed. And if you have a share in that, then that gives you an extra incentive to do that. So that's what growth shares are intended to do. It's all to try and make the business go better for everybody's upside.
Thanks, Robert. No, I just thought it was a good time just to ask you about that, because in the current environment, what we're hearing from our clients is that it's really hard to retain their best people, their best talent. So using, as you said, employee share option schemes or growth schemes or growth shares or something similar can be one tool that a business owner can use to retain their best people. Thank you for that.
Yeah, and it's interesting that there's, it's an existing business can do that, Larissa, absolutely. It's interesting, we see on different investments that we do, or even, private equity acquisitions, that sort of thing. There can be quite interesting mindsets, even from an investor, who might come in and might say, hang on a second, are you not going to incentivize your, so there's different situations
Yeah.
that it's appropriate or isn't appropriate. But,
Yeah.
it's definitely something that, you're right, it can be very, depending, markets can shift and suddenly there's, it's less of an employee's kind of market. But you're right,
Yeah.
absolutely, that we're certainly hearing of that as well, and seeing it that you need to incentivize and actually, if you can give people a stake in the business and a kind of a genuine incentive for the business doing well, and an opportunity to actually make quite a lot of money potentially with
Yeah.
some of these shares. Obviously a lot of these businesses which are fast growing, nobody knows what they could make eventually. And if you own a percentage of that, particularly where if you resign, you lose that. I think that's a really clever way to try and incentivize and retain people.
Yeah, great. Thank you, Robert.
Grant, and so types of investor, there are different stages of kind of a company's journey, I suppose, if they're going through rounds of investment or they're at a different sizes and that sort of thing. But there are very different types of investor, just to be clear on that. So there's the kind of the high net worth individual or friends and family investor. And to be clear on that, we see quite different ranges. There's people out there who have deep pockets, I suppose, and can invest quite sizable sums of money actually in businesses. So there can be quite big investments from individuals. But generally speaking, you're talking kind of earlier stage, perhaps that somebody might write a check and invest for a percentage of a given company. Then you're into more the other three that I mentioned there. And the slide doesn't talk about kind of semi-state enterprise Ireland, that sort of thing as well. But venture capital, they're looking obviously for venture capital and private equity. Typically, they're not going in to stay there forever. They're going in to then three to 5 or 5 to 7 years later to sell what they've invested, or to exit or sell at a far higher price than what they've invested. So, that's what they're looking for. Venture capital are slightly different. They're kind of earlier stage sometimes, not always, but they're more in the kind of high growth, sometimes tech, but different types of business, but a lot of tech, I suppose. High growth, high potential, where there's perhaps a higher chance of not making that return, where a VC will accept to some extent, and it depends on the risk appetite and their own particular VC that it is, but they will accept that there's going to be some level of risk involved, and they will accept that if they have 20 companies or 50 companies in their portfolio, some of them will fail, unfortunately. But what they're looking for is that with some of them that are in their portfolio, they'll make so much money from those success stories and from those unicorns and different things that actually it very much more than covers the fact that there'll be some failures in there. But that's the business model. Private equity is a little bit different. It's possibly a different spread of types of investment as well. Less tech focused, I would say, but there are some tech private equity investments, of course. But it's slightly later stage. They again are very much looking at getting into a business. I think there's kind of a traditional, particularly in Ireland, private equity in some quarters was more of a dirty word than it is now. I think it can be very good, very helpful for businesses. There's an experience there, there's a maturity there. If you bring a private equity investor in, they will see things that perhaps the management team who've done so well to build a business to a certain level, but they mightn't have every area of kind of growing a business covered. They will help to improve. Like I work with quite a number of private equity clients, and the way that they can push a business on and help everybody involved do very, very well on an exit 5 to 7 years later or whatever it might be is actually can be really appropriate. So that's what they're looking to do, and they try to bring value to the table. There are kind of different efficiencies they might like to drive within the business, but that's what private equity is. And then when I say corporate there, it's a different type of investor again. A corporate is an operating business that actually might invest in another business. So that's quite different, because a corporate could actually acquire another business or take a minority stake in another business and actually want to keep it forever. They're not immediately saying, right, we're getting in there and we want to exit in 3 to 5 years. So that's what we're working towards, immediately making money on that exit. A corporate will typically be very different in the way they approach it. They'll want to integrate with their own business. Usually they'll be doing this deal because it's complementary to their own business. So quite a different thing. And then, as I say, the semi-states like Enterprise Ireland that are different, they're kind of they're there to help the kind of domestic economy and that to assist up and coming businesses, and they can be really, really useful as well at a certain stage. We see Enterprise Ireland and they do a huge amount for a lot of businesses in showing them what they need to be thinking about and bringing them along the journey. I think we all have a poll here I see to answer about have you received funding before, which will be useful just for us to get a sense of different different people and whether they've actually received funding before and the different types. So maybe attendees would have a look at that and answer that while we're talking. But I think
Yeah.
that's
No, that'd be great. Thanks, Robert. Yes, if everybody please can answer that question. Just before you move on, Robert, would I be right in saying that individual venture capital type investors are more leaning towards startup companies and private equity would be more leaning towards the more established business?
I think that's right. Now, I think it depends on certainly individual investors or friends and family. Totally, Larissa, I agree with that. I think with venture capital, yes, but it depends on the venture capital firm. I think with some of the VCs here in Ireland, yes, they'll be doing investments of kind of sub a million and that sort of thing, and very much kind of up and coming businesses and fast growing businesses. But then you see, VCs that have a very different. It depends. You see, they typically would. There's different models, but they'd have funds that they've raised from different investors themselves. The VCs have, and within that, they'd have a mandate. They'd have a kind of a part. Usually, they'd have a partnership agreement, if you like, an investment agreement where they have horizon. There's parameters within which they invest. So for some VCs, international VCs, and so on, the amounts they're putting in are huge, hundreds of millions. So it's not early stage, but it's still kind of mad, fast growth type, even though they're very developed and they're unicorns. Whereas private equity, it's a little bit different. You're right, it might be more developed, but it's not. It's looking at kind of perhaps more settled, profitable businesses. That's what we'd see. But I suppose, each PE and each VC has its own story, really.
Yeah, no, that would be my experience. But private equity would appear to me, certainly the conversations that I would have with clients, they would be looking, as you say, to looking at profitable businesses that are already demonstrating that they can make a decent return, but they struggle with the finances to take it to the next level, or as you said, perhaps even the skill to take it to the next level, or both. So it's important just to recognize that, depends on the stage of business that you're at and your rate of growth and the potential market will may depend on the type of investor that you look to attract.
Yeah, and there could be different reasons, by the way, for taking investments. Or what we see sometimes is this concept of founders taking some cash off the table. Now that won't typically be entertained at a very early stage or before you're profitable. But you could take an investment, and it's quite a normal feature of private equity deals where there's an investment for different reasons into the company, but say 30 or 40% of the investment actually is an acquisition of existing shares. So the founders have grown this profitable business, and they're might have, very successful business, but at a certain point in time, you can understand they haven't actually made money out of it personally, and so this it can give quite a way to kind of for them to do that, to get some return from it while still owning a large stake in the business and still having an opportunity to make more serious money later on. But it's definitely a feature of some deals, and you can see it in VC as well, but it's less common.
Okay, thanks, Robert.
All right, so I don't want to focus too much on this next slide, but it's just something that participants should be aware of. It's there are, when you're taking investment nowadays, regulatory issues to be aware of. I think competition is one, so it won't be an issue if the turnover in your business is below a certain threshold, which is actually 10 million. So for some of the attendees, that won't be relevant, but just something to be aware of, in particular if it's in certain sectors. You do need a consent to do a transaction if there is a change of control, as defined in the relevant legislation. So it's not just over 50% of the shares changing hands. And you need to get a consent from a body called the CCBC, which is essentially if a business is changing hands or control is changing hands, it just needs to be looked at whether it's causing a competition issue, I suppose. The idea being that there should be competition in the market. So if two competitors merge, that reduces competition. But the test is done by turnover. So it's just something to be aware of. The second one that I list there, foreign direct investment, it's even more of an issue, probably for a lot of the attendees here. It's something that's coming in. I suppose it's a regime that's coming in possibly towards the end of this year in Ireland. And what it says is that if there's a third country undertaking, which would include the UK, if there's an investor coming in from the UK or outside the EU, that if the ticket size of the deal is more than 2 million and you're getting investments, then you need to look carefully, or your advisor needs to look at whether there is a notification and consent needed from the regulator on the foreign direct investment side. And the idea being that if there's some strategic or critical defense issue somewhere in the business that you have, and you might scoff at that if you don't think that it's relevant. But the issue is that the legislation is quite widely drafted. So you just need to be aware, if you're taking investments that's at a ticket size of 2 million or more, just to rule this out. This foreign direct investments, this new legislation. Don't want to dwell on it because I know it might be relevant to everyone, but it is something to be aware of. And then the last one is kind of a catch-all, sector-specific consents. You just have to be really careful about this. If you're doing a deal, is there anything you're supposed to be getting consent on? You know, going into different examples, if you were doing something in the healthcare, if there's a healthcare sector, there might be a consent needed from HICWA. If it was something there might be something on the central bank side. It's just to be really aware that you need to be advised on these issues and ask the specific question. I would say if it's an early-ish stage investment and you're getting kind of very high level advice, just ask the question and be careful, because these things are a bit black and white. You need to get them right. So that's just one thing to mention there. Okay, so then stages of an investment. I think it's really important when we talk about preparing for an investment, and this is getting into the meat of the presentation, I suppose, or the session. There are different stages. I think one thing to say is the investments we're talking about are not public markets type investments where there's a very, very clear and set out timeline you have to follow in different stages. But this is the way it works in practice. So you have usually sign a term sheet first, okay? And that term sheet will not be binding, but it should set out, this investor is willing to put in X million for whatever percentage in the company it might be, and here are the basic terms they want to sign up for. We'll talk about it a bit more later. Then you would usually have the due diligence phase, where the investor is looking at the company. What are your contracts? Where is the business coming from? Are your employees signed up to anything? Different things like that on the legal side. And there would also be, as we'll talk about a little bit more later, tax and usually commercial due diligence as well. But it just depends on the investor and the size of the investment, how deep a dive they'll want to do here. Document negotiation phase. So we talked about term sheet, but then you get into the binding legal documents. There might be an investment agreement, a shareholders agreement. There's a few different documents, and we'll talk about that later. But negotiating those documents, that might run in tandem with the due diligence phase, but it's another kind of phase of the deal, and those are the two main ones. Then completion phase is what it says in the tin. You're actually completing the deal, and you're signing your documents and so forth. And then I suppose the last thing, just to say, are there any consents required? We talked about the regulatory piece before there. And sometimes you will sign binding documents, and then you can only close the deal once certain consents have been obtained, or something has happened. It might be financing, it might be something else. So sometimes you'll split your signing and your closing, but often it's simultaneous. So they're the kind of stages of a deal at a high level.
Robert, maybe you're going to get into this, or just to get your opinion and insight. How long on average does this process take?
Yeah, it's definitely it's an important question, and it's how long is a piece of string. I've seen deals done in, like, proper big deals done in a couple of weeks, basically, but that's not normal. I would say usually between the jigs and the reels, you're talking kind of 3 to 6 months anyway. And that's kind of from the point that you have a term sheet signed. I think a lot of factors come into that. I think the level of preparation of the investee, or the seller, is really important, because if a standard due diligence request list comes from the investor or the buyer, which you would expect to happen, and those can be quite long. And suddenly the investee is saying, oh dear, I don't know the answer to a lot of these questions. I don't have my documents ready. I've literally seen situations where on a good deal, good size deal, the seller goes off for 2 or 3 months to actually answer those questions, which the deal in question I'm thinking of, which was last year, it's still closed towards the end of the year. But it's in some situations, if you kill the momentum that badly, it mightn't recover. But anyway, you have to take into account if that happens, it's going to take longer. And then negotiation can be really detailed, or it can happen. It depends on the approach of the parties, really,
Okay. No, that's really interesting just for those on the call, because I think for the due diligence phase, as you say, the seller can go away for 2 or 3 months and try to answer all the questions and pull together all the information and drop everything into the data room and do all of that. But if you are setting your business up to sell in the future, then it might be a good idea to know perhaps some of the information that an acquirer would look for, and to start to build it up as you go along on a monthly or quarterly basis, to save you having to do a lot of that legwork when the time comes.
Larissa, I think that's really, really important and good suggestion. I think, to be honest, the kind of standard due diligence request list you get on the legal side, and there can be other ones as well, obviously on the commercial side and so forth, but it doesn't vary that much really from, the kind of big law firms will have standard enough request lists. Now, there's different questions that can come into it, or for a certain type of deal, there would be an expectation that you shorten it and you focus on the important things. But you know what's coming, or if you don't know what's coming, it's because you haven't talked to someone, or you don't, that shouldn't be a surprise when it comes. And I understand totally that there's a million things for a business to focus on and a million things to spend your time on, and that's growing a successful business. But I think doing that exercise, if you're serious about taking investment or a sale, even whatever it might be, it's crucial. It's a really valuable step, because once you're in the red hot kind of environment of it, it's a killer. Momentum is just so important, and it's a killer if you have to step away and essentially take a load of time to pull all that information together.
Oh, it's a complete time suck, isn't it? Like, you're essentially giving up running the business, seek investment, or to sell the business. So, there's something just to bear in mind if you're serious about this process. It does take a lot of investment on your part, to make it successful.
Yeah, and it's actually a point I hadn't even put in the slides, but as you said, Larissa, that's right. You probably have to think a little bit about internally. It depends on the size of the business and all the rest of it, but how are you going to manage that? We see different approaches where the CEO gets on with running the business, and the CFO might be running the process really, from the company's side. So it just depends how you're geared up, and you might have the relevant management team that you can do it. But it's just, don't underestimate the time and effort, because there's due diligence questions, then there's trying to negotiate the documents in circumstances where you mightn't be that familiar with some of the terms coming back and forth, and it can really suck you in. So it's an important point. Yeah. Hopefully we're not putting everyone off.
No, I know. I don't want to put anybody off, but it's just about being realistic and being real about the process. One final question before you move on, and that is, term sheets are agreed, due diligence is okay and relatively successful. Approximately how many deals don't complete in your experience?
It's a really good question as well, because that could really vary depending on the environment, and that's the economic environment. I would say in the last couple of years, I have seen a lot more deals not complete than I would have seen probably in the 5 years or 10 years before that. And then you would have seen a lot of deals not complete in the years after the financial crash and difficulties in Ireland. So I'd say it's relatively common. I'd say, Larissa, in the last couple, for whatever reason, investors can be a bit. When people ask me what are the reasons, when I go back through deals I've worked on the last couple of years that didn't end up happening, what were the reasons? I actually think it's not typically that investors find something in their due diligence and they don't want to go ahead. It's actually more the attitude of the company almost to,
Okay.
if, to the deal, to the process, deal momentum falling away. You can sometimes find an investor, something happens in the sector that's outside the control of the deal. That was one I saw last year, that just something came in the Sunday papers. It was really
Oh,
unlucky,
okay.
just in terms of the sector in question, and they just got a little bit, the investor group got a bit spooked. I've definitely seen a thing where the messaging coming back to the investor was wrong in terms of respect for the suggestion to the investor. Like, investors feel, if it's VC or private equity, they feel that they have something to bring to the table, and they want if they find things, and they don't want to be just dismissed sometimes. And that's the dance that gets danced, to be honest. You find things in due diligence, they get suggested, they get put back to the company tries to dismiss them as irrelevant. But you just have to navigate that carefully, because, what I saw is one deal that fell over. The investor just felt they weren't being listened to, and they felt that was a negative message in terms of whether they'd be listened to after closing, when they became a director of 5 directors on the board. And it's not, when these deal documents we talk about get signed, they then get put away in a drawer somewhere. They don't really get referred, like 99% of the time. They don't get looked at. So it's more about relationships then, and partnerships, and is the investor going to feel that they're being listened to? So listen, I think those are some of the reasons, but I can't put a percentage on it, but certainly it's where I've heard people, lawyers on things like this in the past in different environments, say, oh, once the deal starts, it nearly, it would close. That's not the case at all. So you can't take it for granted. And that's why some of these messages are important in terms of being prepared and not letting something you do cause that.
Yeah, no, really good advice. Thanks, Robert.
Okay, so I think we can move on to the next slide.
We just have one question from the
Oh,
audience
good.
there as well,
Yeah.
from Kieran. If you have multiple investors, how do you mitigate ongoing document negotiation of the shareholding agreement?
Yeah. Okay. So if you have multiple investors, it's a really good question. It's a really important point. And that can definitely cause issues. So if you have a new investor, and I think I understand the question saying, if you have a new investor and then you have multiple shareholders sitting out there, or you have 2 investors at the same time, I think what you want to do is you want to just make sure people are aligned. You need to bring people in on the discussions, and somehow use all your skill to try and not have people raising a bunch of issues. Like, it's difficult. If you have existing investors, they may have the right under the existing shareholder agreement to effectively block the investment, or so forth. So how do you do that? It's a really tricky skill, to be honest, because I think everybody just needs to be clear that this new investment is in everybody's interests. It's new money for the company. Everybody's kind of going to do well out of it, essentially. And the new investor will have a certain amount of negotiating power. That's just the reality. At the point in time that they're saying they're going to put their money in, but they haven't yet. So there has to be just an acceptance, really. This can work in different ways in different situations, but a new investor typically won't just come along and say, oh, there's a nice shareholder agreement. Okay, we'll just sign up to that. They will have their own ideas sometimes. They may want to amend it. They may have a new form of agreement they want. So there's just a little bit of flexibility needed. And particularly if you're an investor, for example, that owns 20% of a company, and there's new money coming in, and you're not, like, you will almost always have preemption rights. So if I own 20% in a company, but a new investor is coming in and putting 5 million in, I'll typically have a right to kind of to match my percentage. So keep my 20% effectively by putting more money in. And if I'm refusing to do that, or if I'm saying, no, listen, it's fine, we'll take the new investment, you have to accept that you're not going to just have the strongest negotiating hand at the table if you're not putting new money in. So I think that's it's trying to navigate, it's trying to keep people up to date on the negotiations, and It's trying to involve people to the right extent while not giving people too much power, if you like, to kind of sidetrack the negotiations or make it difficult to complete the investment. That's all I can say. Like it's a very tricky balance. I've seen it recently on an investment we were doing, and you know, there's different parties being brought in, and they had their different investors had their say at the last minute, and sometimes it's kind of unavoidable. It can just make things tricky, but you just do your best, try and be organized and get there.
Thanks, Robert. I'm sure Kieran finds that helpful. Please do go ahead and share any other questions that you have to follow up, Kieran. But yeah, thank you, Robert.
Great. Okay. And so I think it's just a few tips to bear in mind here in we're talking about knowing how an investment works and the little things that come up. We've talked about this already. Deal momentum, be ready. If you're going to have to go away and take 2 or 3 months to populate a data room, you know, that could go either way for you. You just might, the investor mightn't really be willing to 2 or 3 months down the line. That's a lifetime away, you know. So you have to be ready. You have to know what's coming, and you have to understand the way an investment works, because these things shouldn't be massive surprises when they come. And that's why I say in the next point there, sit down in advance and consider key points. That means with your advisor, or you might yourself, if you're experienced in investments, be able to do that. But I'm a big believer in sitting down with kind of an A4 pad, a blank A4 pad, and saying, okay, what's important to me here? You know, what are the 5 or 10 key points I want to get here? It doesn't mean that you're not flexible, but actually down the road, when you're in the thick of the investment, if you've done that exercise, it can be important for perspective then about what, you know, you can get bogged down with a point on a deal that everyone's negotiating, and it's the last point between the parties. And actually, if you go back to the list you did at the beginning, it mightn't be important at all. So it's just that perspective is important. I say there, who's driving the process? That goes a little bit to the point I made earlier about your CEO and CFO. If the CEO keeps running the business and the CFO drives the deal, a transaction, you'll have multiple people involved. You'll have lawyers, you have all sorts. It's important to have that dog in the game that actually drives it for everyone and pushes everyone. When the lawyer's not responded to an email for 3 days, who's getting on their case about it? It might be the other side, something sits. People will miss emails not because they're away thinking about it, just because they've missed it. So it's important. It shouldn't be happening, but it does happen. And it's important to have somebody who's driving everybody along, because again, a lack of momentum in a deal is how, to the earlier question, a deal will fall over. I think responding to DD questions promptly, I've talked about the initial kind of pack of questions that usually comes. Then what will happen is you'll answer those, and the lawyers, typically, depending on the size of the deal and the DD process, they will be doing due diligence, and they will come up with more questions for the seller. You've got to keep answering those, and you know it can't really take 3 weeks or two. The more you can answer them well quickly, the better it will be for keeping that momentum going. I think unlocking negotiation points is important. I think I love the title of a book. I didn't actually read the book, but I love the title of the book, How to Get Past No. You know, sometimes with unlocking negotiation points, it's not just there's this position on one side of the table, there's this position on the other side. It's often about finding a way that's slightly different to either position that everybody feels they've got to win. You know, so I think it's unlocking those points, and there's a skill in that. And perspective, just what point do you actually care about? Don't lose the deal over something stupid. Don't, you know, but it's fine to negotiate. You don't just have to obviously accept the terms that the investor shoves across the table at you either. And resilience and patience, don't get frustrated. Things cause a deal to take time. There can be delays. It's just to keep going, and it gets there unless it doesn't. But you know, it's just having that resilience, I think, is really important.
But thank you. A question came to mind there, you know, whenever you were talking about what points should an investor or investee really care about. If you're a first time investee and you've never done this before, or even if you have done it before, who are the key people that you should have around you to help you? Because obviously you know the business, right? And
Yeah.
nobody knows the business better than you. But you mentioned lawyers there. I'm wondering who, if I was in this position, who should I have advising me to make sure that I get the best deal for me, for the business, and for the future of the business?
Yeah, so I think there's different transactions at different values, at different stages that it makes, you know, there's a point in time at which you can't have, I don't know if there's any Simpsons fans on, but I remember Montgomery Burns with his team of like 20 people around him just scaring everybody. That's not going to be appropriate at a certain stage if you're taking a more early stage investment. I think the key people I would say, even if it's very early stage, you need to be advised on tax. You need to understand if there's a big tax is a big scary area, I think. I'm not a tax advisor. We do have tax advisors here in terms of tax lawyers, but you can't ignore it. I think you would want a tax advisor involved. And I think it does come down to the kind of the transactions lawyer that you have as well, I think. Those are the two things I'd say are particularly important. I think if you know the business yourself, that's great. If you're kind of if you need some like if there's somebody internally who might know areas of the business that you don't, I think that's important. And maybe, as I say, with the CEO piece, just having the person who can actually do the day to day. What you don't want is getting caught in the weeds yourself and everything. You want an internal supporter. What I'd say as well, I mean, what you see on transactions then is this corporate finance function. It won't make sense because it is another expense. It won't make sense for every deal, but what they will do, what a good corporate finance advisor will do is that dog role that I sort of mentioned there in terms of just being, when I say dog, I mean being like a dog with a bone, and just making sure, and they can be really annoying, don't get me wrong, but they ring everyone up and it's kind of, you can't delay, like it just keeps everyone honest. It's setting deadlines. It's saying it's organizing a weekly call. It's like, where are we with this work stream? Where are we with that work stream? With that, chase that, because you know the way it is when there's so many people involved, sometimes things can fall between two stools, or somebody can have a million different competing things that they need to do, and the deal mightn't be their first priority. So it keeps everyone honest. So that's the one that's useful. It doesn't have to be a corporate finance advisor, but it has to be somebody else if it's not them, you know? So I think that's that's the other one. But I think certainly somebody to chase everybody up, a good experience, and the right transactions lawyer for the right deal, I'd say, is important, because there are great transaction lawyers out there, but not all of them are fit for purpose on every deal, to say that. And then tax is the thing that scares me and should scare everyone else.
Yeah, absolutely, absolutely. And I would just add to that, actually, if you're a founder or a CEO, on the other side, so on the side of whether, you're talking about the finer details and making sure that, that everything's correct and that you've got somebody there, and that's really important. On the other side, for your own for the business, for, if you have somebody in your corner, or perhaps it could be a board, it could be advisory board, it could be a formal board, depending on the stage of business that you're at. But those objective opinions as well will be really important through this process.
Yeah, absolutely agreed. Yeah, no, that's totally a fair comment. Yeah, agreed, Larissa.
Thanks, Robert. Okay, will we move on?
Okay, and I'm conscious we've actually gone 45 minutes, so I won't spend too long, but just to say another word about the first thing we said, which was term sheets. It's the first thing you'll sign, and just a few pointers on them. You could do a full session on them, to be honest, but they are not legally binding in terms of the terms of the deal, or they shouldn't be if they're drafted correctly. You might have a binding provision around confidentiality. You might have a kind of a lock-in period in it where you can't go and do the deal with someone else, but they're non-binding in nature. But they do have a moral authority to them. So it's very difficult if you sign something in there in the term sheet, then go and renegotiate it later. So just to be aware of it. I wouldn't advise generally to get into too much length in the term sheets. Keep it quite short and simple, because what can happen is you go down a rabbit hole, and actually the term sheet ends up taking ages to negotiate, and that could be a problem. Just if there's any kind of founders who are presented with a nice term sheet from an investor and it all looks very official, please don't sign it if there's anything in it you don't understand. I'm sorry if that sounds patronizing. I'm sure people wouldn't do that, but get advice, because if you've signed it, then it'll be very hard to not sign up to that particular provision in a binding document. I've seen term sheets that have been a total disgrace from kind of businesses, from target businesses, investee businesses, where some investor just puts in some of the most crazy stuff. It's like total kind of distressed fire sale type mentality on it when it's a perfectly good business. So really just get advice on it, I would say. If your gut tells you it doesn't look quite right, then trust your gut. You know, and do get that advice and be very careful what you sign up to. I think though term sheets do have very much a value, and I would sign them as opposed to just not doing one, because I think later on you don't want to get deep into transaction documents, incur costs, incur your own time sink in it, and then realize that there's just one or two or three deal breakers in there that, you know, the deal was never going to go anywhere. So term sheet will flesh that out, hopefully, you know. Then the next stage we talked about was due diligence. We've talked about this a little bit, but just to say what we expect typically on due diligence is that there would be a virtual data room nowadays. We don't have physical data rooms anymore, or I certainly haven't seen one in many years. So there's loads of virtual data rooms. Just be careful with what you set up. Some of them are absolutely terrible. Some of the free ones, you might want to use a free one. I think some free ones are fine. But again, just be careful of the signal that you're sending to an investor here. It goes to, I mean, for example, I know the guys in Kinor do you know, in terms of company secretarial services that they do for you, you can have a very good, you know, the first thing that people see with due diligence, they shouldn't be seeing, they haven't filed their annual return and they haven't held board meetings and they haven't had a general meeting last year. Those are services Kinor can help you with, but you need to have those documents. There's one, are you actually in good shape in terms of compliance as a company? But two, can you show it? Is it an organized data room that has, you know, has your 10 or 15 or whatever it is, different sections, and then you break out the subsections. Very easy to do, but very easy to give the wrong impression to investor at the beginning of the deal when you don't have a data room or have a very, very badly organized data room and people are pulling their hair out before they even get going. So as I've said earlier, there's a standard due diligence questionnaire that will typically be provided. You know, it's there. You can find out what it is before you're even thinking about a deal. So I'd probably advise people get hold of that. As I say, have the data room going before the deal actually starts. There's different types of due diligence. We're focused on the legal due diligence, but there can be commercial and tax as well. So it is just, I talked earlier about resilience and all that. It can be a bit of work. So just to be aware of that. I say there are questions and answers. I've mentioned that already. So the due diligence questionnaire goes in. It might be answered by reference to the documents already in the data room, but you answer them within the relevant column in the questionnaire, and then there will be a due diligence exercise. And if we were, for example, on the investor side, we might come up with a bunch of questions about stuff we've seen. So we might see something in a commercial contract where we're not clear how a commercial contracts framework agreement might marry up with the purchase order or something like that. And we'll ask the questions, we'll go back. And as I say, that's where you want to keep that momentum up because you understand the business best. Key legal topics, commercial contracts will tend to come up. What are the contracts that the business actually operates under? Are they signed? Are they in place? And then you'll be looking at the terms of those. Is the liability capped? Are you giving away indemnities? All the rest of it. The structure, the corporate structure and compliance. Do you have employment agreements? You know, do you have contractors or employees? Is the intellectual property protected? Are there IP agreements or assignments there? What debt does the group have? What are the terms of that? And real estate, is the release? What else might it be? And there'll be other things as well, but that's snapshot.
Robert, honestly, we could talk about this all day, and we only have 10 minutes left. I just want to pick up on one point. You said
Yeah.
around the virtual data room that there is loads of free options available, and there is loads of free options available. But you said you have to be careful of the impression that you send to the investor, which I
Yeah.
agree with. Is it normally the investee then that sets up the data room? Is that normally what you see?
Yeah, that's exactly the way it would work. Now, the investee might set it up via their advisor. Lawyers, most law firms, including ourselves, can actually set up a data room for you now. Years ago, the lawyers wouldn't have done that. But there is that facility now to do that. And then you can actually do it yourself. Like, you can look at there's Google. Google have ways to do it. I'm not a massive expert, to be honest, on going in and setting up a data room via Google Drive and all of that, but you can do it very easily in this day and age. The only thing I'd say is I don't want to speak ill of any provider, but there are some that are shocking. That you just be careful. You set them up, and they're impossible to navigate, and all the documents just change and the references. You just don't annoy the investor before you even get going. Just have something that's coherent, that they can see an index, they can see what documents are there, they can decide what they want to get their lawyer to have a look at, or their other advisors. So it would be the investee. Now and then, like, it wouldn't really make sense for the investor to do it. The investor is reviewing what the investee is telling them. So it can happen. Just if, let's say, the investor has lawyers who are a bigger law firm, and the law firm has an ability to do that. We've seen that where we're on the investor side. Sometimes we just end up getting asked to do it, and the company provides loads of documents to us and have to put it in a data room. But that's unusual. It's usually the investee that would do that, and you just want to paint that picture for the investor. That's all very nicely organized.
Yes, exactly. Great advice. Thank you, Robert.
Okay, Grant. So then, what are the actual core investment documents? This is the binding documents after we've gone past term sheet stage. A subscription agreement is the document under which the investor subscribes for shares, and typically the investee company, will give warranties, and there's different protections in that. Shareholders agreement is different. So after the investment has happened, typically then you'll have multiple different shareholders, and you might already have multiple different shareholders. So the shareholder agreement sets up how their rights interact, and with the company, who can drag whom into a sale, all of that good stuff, who gets a board appointment right, etc. There's loads of things covered in there. A disclosure letter, if under the subscription agreement there are warranties. So warranties are statements of fact about the company. And if I'm the company and I'm giving 10 pages or 30 pages of warranties, which is all very normal, the way that works is I give a warranty that there is no pending or threatened litigation against the company. If that's not quite correct, that there's no pending or threatened litigation against the company, then I would give the statement and the warranties, but then I would have a disclosure letter under which I disclose any exceptions to those warranties. So that's a different document. I put secondary share purchase agreement with a question mark on it. What I'm talking about there is the point that I made earlier about taking cash off the table. If you're in a fortunate position as a founder that you're taking a 10 million investment for example, and the company is coming in and getting a 40% stake for that 10 million, you might be able to have a situation for 5 million of that 10 million is actually being paid to the founders. And they're selling shares, they're selling those 5 million, and you do that under a secondary share purchase agreement, and then 5 million will come into the business for its capital expenditure and whatever else it wants to do with it. And then employment agreements. So there might be new employment agreements as part of the deal. That's very normal, because sometimes an investor will come in and say, yeah, I don't really like this very weak and badly drafted employment agreement you have here that you got from a template on the internet. We need to see really robust protections and non-competes and things. So often an investor will have a very set idea of what the employment agreement should look like. Okay, and then listen, we're nearly out of time, but there were some key negotiating points we'd see. Sometimes if an investor comes up with or finds issues with the due diligence, they won't typically just pull out of the deal because of that. They find a way to get cover under the documents and indemnities. So if you spot a risk in your due diligence, sometimes you will negotiate an indemnity for that. They're less common, to be honest, on investments than they would be on a sale. So if somebody is selling the whole business, you'd sometimes get indemnities. I've talked about warranties, caps on liability. So as a company, you want to be careful of that. If you're giving protections under the documents like warranties, you want a maximum that a claim can be brought against you on that. And then there's different set of protections where if it's a nuisance claim of €2,000, for example, you wouldn't want any of those claims brought against you. It has to go over a certain basket. We've conditions to completion and due diligence issues, that come into the deal documents. Restrictive covenants, I've said there. If I'm an investor investing in a company, I don't just want the founder leaving a month after I've invested and setting up a competitor business straight away. So we want non-competes in there. Consent rights. So basically, an investor, if they're putting in a bunch of money, they won't want certain things done without their consent. And that's a list that will be negotiated. Board appointment rights. Who has the right to appoint a director? Drag along means if I'm a 40% investor, do I get the right to pull everybody else into a sale without their consent? And equally, if can others choose to go along with the sale? Preemption, if somebody wants to sell their shares, everybody else is going to want the right to have the ability to buy the shares before they're sold to a third party. We're getting into detail now in a few things, but liquidation preference. So sometimes if an investor comes in, they're going to want to say, I'm putting 2 million in. If there's a sale of the company and it only achieves €2 million, at the end of the day, I get that €2 million before anyone else gets a penny. That's what a liquidation preference is. And anti-dilution is if in the future, God forbid, it's a down round where an investor has invested at a certain value of the business and later on there's a lower valuation, then the investor will get kind of extra shares essentially to make up for the fact that there's been a down round. Those are all the things, and they go to the point I was making earlier about if they're not familiar concepts, you just need somebody by your side who can help you through that, because it's all very standard. It's fine, but you don't want to be signing. Sometimes people throw outrageous stuff into these documents, which isn't standard and isn't reasonable, and you just need to be able to spot that.
Yeah, thanks, Robert, because it's all standard, isn't it? But certainly for me looking at it, I think, oh my God, none of that is standard to me. So I think if you're
It's okay.
that's
Yeah.
if you're looking for investment or looking for a sale, that's why you have to have the people who know what all those things mean in your corner. Yeah, thank you, Robert. Great advice.
Okay, and I think that probably brought us more or less to the end. We haven't left enough time for questions, I know, but there was one or two in the middle. I don't know, were there any more, Christina, that came up, or yourself, Larissa?
Yeah, we don't have any other questions from the audience, so unless they want to submit any questions now, but thank you so much for all of your insight and advice there, Robert. That was very, very helpful. And thank you, Larissa, for hosting today.
I have one question. We have 2 minutes left. So I have one question, Christine, if you don't mind. Robert, I'd love your insight on where we're at now currently, the current investment environment for those on the call who are looking to try to get investment for their business or indeed look for a future sale. What's the environment like currently? Is there money being invested in companies at the moment?
Yes, there is. I would say for sure. I think it's just been such a strange number of years. You had the pandemic, but actually during the pandemic we had this massive tech boom. We had this huge investment happening. Then you got to kind of 2022, and things probably then fell back somewhat. You had a lot of layoffs, tech, and all of that. My sense is, and the whispers are that there's actually a very good period coming in terms of all of that. Who knows? Because there's all these geopolitical things just throw everything out. But I would say the horizon looks like it could be pretty good actually for the next 15 months. But we'll see. Different statistics come out, and then a headline can throw it off because there's different levels of investment at different stages of the market. But my sense, quite honestly, is that there's no reason, if your business is ready for investment, there's no reason to not proceed with seeking that. And it's not a bad time at all, I would say.
Super. We're ending on a high. That's great. Thank you,
Yeah.
Robert, very much.
Thanks so
Okay,
much
all
for
right.
both of you.
Thanks very much. All right. Cheers, Christina. Thanks, Larissa.
Thanks now. Bye-bye.
Cheers.
Bye-bye.
Bye now.
Bye-bye.
Bye.